Hi, good afternoon, everyone. Thank you so much for joining us today for our quarterly webinar series, CIO's Corner, quarterly update with our Chief Investment Officer, Chris Gauthier. And for those of you who might be joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth. I do just want to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be, of course, monitoring all of those and asking Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and are unable to get to the question that you submitted, Chris or myself will reach out to you directly after the webinar to make sure we do get your question answered and have a private discussion after the webinar is over. I do want to go ahead and introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of experience with investment management, specifically with our firm, and working with both institutional and individual investors. He's responsible for setting our firm's overall investment policy and strategy, which includes directing our asset allocation, investment risk, research, and portfolio management functions. Thank you so much for speaking with us today, Chris.
Thank you, Amanda, and we'd like to thank everyone for joining us today. Nice to see the sun out today in New England for a change. And I want to remind everyone, as always, any feedback you have on this presentation, we try to do this on a quarterly basis. What we're doing right, what we need to improve on is always welcome. We have a lot to cover today. So let's jump right in. What we cover today, first, look at asset class performance. As we'll see, financial assets extended their gains in the second quarter on the back of strong corporate earnings. We're going to hold for 1 second. Like almost an echo. Can you hear me?
I can, yes.
Okay, yeah, I was getting a lot of feedback on my microphone. So if at any time, Amanda, it doesn't sound like you can hear me, please let me know. Okay. I think we should be good now. So to restart, sorry about that. Little technical difficulties here. All right. So like I said, asset class performance. So what we're looking at is financial assets really did extend their gains in the second quarter on the back of really strong corporate earnings and expectations that the post-COVID reopening of the economy is still on track. We'll take a look at the current investment environment, and it really does point to higher interest rates, higher inflation, and above trend economic growth, really against this backdrop of extended valuations. And then we'll look at how that relates to portfolio positioning, how our portfolios are positioned to manage risk and really take advantage of opportunities we see in the marketplace. And as we'll find out, where you take risk will be more important than the amount of risk you take in 2021. So I'd really like to go over our investment philosophy before we start the presentation. It really provides a nice framework for our discussion. It's really how we view the markets and really helps to shed some light on our thought process and leads to a better understanding of the conclusions we come to. So we always believe mean reversion, trees don't grow to the sky. Price matters, what you pay for something really does drive returns. We look at exposure to core factors to really offer long-term excess returns above what you can get in the basic market. Diversification is still the only free lunch in investments. And active risk management is a priority in portfolios because we do believe risk is not stationary, but really does fluctuate throughout the market cycle. So given that framework, let's take a look. I'm going to take a look at performance in the second quarter 2021. Like we started off this, we really saw global equities really advance for the 5th straight quarter, really led by US equities, which are seen here with the blue bars. So anytime you see a blue bar on the chart, you're looking at US equities. International, which is represented by the green bars, think about international European, think about emerging markets, really did not keep pace with the US equity market, but it still posted strong returns. As you saw, international and EM were both up over 5% in the quarter, so very good returns. US really led by the NASDAQ, and you can see that on the chart right here, 11.32%. And it really led by as a fall in interest rates in the quarter, helped large cap growth stocks, think FAMAGA, which really are overrepresented in the Qs. For the same reason, we saw large cap US equities beat small cap US equities. And with that back up in rates we saw in the quarter two, fixed income posted modest gains. They're represented by purple on this chart, really led by long-term treasuries, up to almost 7%. And they really led because duration beat credit in the quarter, which we'll take a look at, with corporate bonds up about 4% and high yield bonds up about 2%. Turning to alternatives, it really was a tale of two cities in alternative land, represented by the yellow bars. As the long-term downtrend in the dollar continued, as it was the worst performing asset class, as it lost over 1% in the quarter. Other than the dollar, cash, represented by short-term treasuries, was the only asset class on our chart to lose money in the quarter, as we saw the short end of the curve, fixed income curve, rise, which we'll take a look at a future chart. And then while alts had the worst performer in the quarter, it also had the best performers, led really by oil, which continued its torrid pace, as it was also the best performer last quarter, and really has finally joined the other classes in reclaiming its pre-COVID levels. It was really lagging there for a while. It's just kind of catching up with its equity brethren. Precious metals, represented by silver and gold, also had a strong quarter. Silver raced ahead almost 7% in the quarter, and gold was up 4%. All in all, taking a look at the quarter, really not a lot to dislike from a financial asset performance standpoint in the quarter. Everything really performed well. And as you know, when we talked about, we view the US large cap market through a multi-factor lens, think value, quality, momentum stocks. And we really saw that quality stocks were far and above the best performer, up almost 10% in the quarter, which is represented by the red line. It was the only factor to really beat the S&P 500 in the quarter, as we saw value, income, momentum all trail. Momentum stocks, stocks that tend to have good reason price performance, was the next best performer, up almost 8%, but still trailed the S&P. Value and yield, which are very closely related in terms of factors, brought up the rear at 3% and 4% respectively. But as we saw in the previous broader asset class performance chart, it was a pretty good quarter, no matter where you were invested. But as always, there are pockets of opportunities within asset classes. So taking a step back and kind of looking at a much longer term chart, we're looking at a 1-year performance now. Same asset classes we saw at the quarter, very similar in the rank order as we saw in Q2, with oil leading the way, followed by the US equity, again represented in blue, international equity, fixed income, and the dollar again bringing up the rear. That is really where the similarities end, as you saw a complete opposite of the internal rankings within asset classes. As when we look back over this year, we now see that small caps, up almost 70% over the past year, lead large cap US equity, represented by NASDAQ at 44, and the S&P at 40. Emerging markets now are ahead of developed. Credit now leads duration by a large margin, and long-term treasuries, think about duration, the impact of rising rates, are in negative territory over the past year over year, along with the broader base fixed income ag, which is represented by ticker AGG. We also saw in the past year gold go negative, down about 68 basis points on a year over year basis. US small cap equity and oil really led on the back of a continued improvement on the COVID front, which is really allowing the reopening of the economy to continue. With this economic expansion seemingly on track, we saw rates rise on a year-over-year basis, which really hurt the dollar and long-term treasury performance. In that fixed income land, the more risky parts of the market, like high yield and floating rate, led the way, posting double-digit returns, even as a broad-based ag, like we talked about, and the safe US treasuries posted declines. As we stated in the beginning of this presentation, this really is a good example of where you take risk and not the amount of risk will be the most important driver of portfolio performance as 2021 unfolds. Now, taking a look at where we are on the S&P 500, looking at a longer term chart, you can see the big dip due to the COVID in March, and you see the massive rebound off the bottom coming up, and we're again reaching all-time highs in the S&P 500. But it is a different environment than we've seen in the past. When we look back and we think about 2007, at March 2019, we look at the little call-out chart here. This kind of gives you different levels in terms of how expensive we are compared to history. Dividend yield, 10-year treasury. Pretty much, we're much more expensive than we were, but the big difference you see, and we'll talk about this as the presentation unfolds, is this 10-year treasury rate, where back in 2007, it was almost 5, even 2020 was 1.6, and now it's at 1.5, which is extremely low levels, which we don't think is sustainable. As you look at that dip, it's interesting to note the NBER, which is the economic entity that kind of defines recessions in the US, just announced that we had the shortest recession in history due to COVID. The recession actually lasted 2 months, March 2020 to April 2020. That was followed by the longest expansion we've ever seen from that 08 period up until the COVID of 128 months, almost 10 and a half years. So again, hitting all-time highs, bouncing off the lows, things look like things are moving in the right direction from the S&P 500. One thing that's going to have a major impact, and it could be positive, it could be negative, is COVID. I really look forward to a time when I don't have to talk about COVID, we don't have to show a chart. Hopefully we're making progress, and the data says we are, but it's always a presence in the markets, and we have to take it into account. Looking at this chart, on the left-hand side, you can see the new daily confirmed cases across the world, Brazil, India, European Union, the US, and we can really see the impact of the Delta variant as we're seeing a surge of new cases in UK and India. And just as a reminder, this data is as of June 30th, 2021, so it doesn't really take into account the recent rises we're seeing in July in the US. So I'm really going to focus on the UK and India here, because I really does think it provides an example of why this time is probably not the same as in March. And you can see this on the bottom right-hand chart, which is looking at the COVID-related new deaths compared with South Africa in blue and United Kingdom in green. You can see that diverging trends in the fertility rate, and that really has to do with the vaccination rate. I mean, look up here on the chart, you see the UK is almost 60% vaccinated, where India is only 20%. And you can see the vaccination really does make a difference in terms of the impact COVID has to the population and to the economy. No pickup in the US as of June 30th, like we talked about, but we are hearing more anecdotal stories, in the press lately. We really have to watch closely for any change. But for now, it really looks like good improvement on containment, and the reopening of the economy won't be derailed. One way to get an early read on the economic impact is by looking at real-time data, which really only became available in the past few years due to the rise of cell phones and Big Brother watching you wherever you go. And that's what we're looking at right here, the real-time data compiled by JP Morgan. And really looking at this data, you can see it starts in February 2020. So this zero line represents, pre-COVID levels, and anything above that means we've reached that level. And anything below means we're not quite back to that level yet. But looking at the data, expansion is on track and the trend is in the right direction. We see small dips here and there as a reopening, really is, it's not an event, it's not a one-time happening, it's really a process. We would end up being less constructive on the markets if we saw a change of trend in this data. We're just not seeing it yet. So again, the economic expansion looks like it's full steam ahead as of right now. And one thing we think is going to support this is just how far we fell during the COVID. And what we're looking at here on the left-hand side is GDP, and normal trend growth for the US economy is pretty much pegged at 2.5. You can see the big dip down as COVID took its impact and this big rise up. In 2021 Q1, it grew at 6.4%. And we can see the damage done by the COVID-induced lockdowns and just how far we have to go to get back to that normal run rate of 2.5% growth. This gap is why we believe the economic expansion has room to run here as 2021 unfolds. And we really do expect above average economic growth to continue, barring any shock to the system due to COVID. We still have a lot of ground to make up. So there's a lot of room left to run in the US economy. And it's not just a US phenomenon, it really is a global coordinated economic expansion. We're looking here at the PMI surveys, which is looking at services on the left-hand side, manufacturing on the right. We can see that all major economic zones across the world are currently in expansion mode. And expansion mode is defined by anything above 50. So if these lines are above 50, that means the economies are in expansion. And I like looking at PMIs, and the really good thing about this is that they really tend to be more forward-looking, right? They're a diffusion index. They're asking companies, are things getting better, staying the same, getting worse? So when it's above 50, companies are saying things are getting better. So that portends to more economic activity and really gives us more insight into the future path of economic activity than other historical looking data points like GDP. So another positive for financial markets is the expected growth of corporate earnings, represented in the left-hand chart. You can see that the expected growth rates are all positive. No surprise there, coming off the bottom of the COVID. But more importantly to us and more importantly to portfolios, the growth estimates continue to be revised higher, which is on the right-hand side. And what that's really looking at is analysts' upgrades and downgrades to earnings estimates. So if it's above 1, it means more earnings estimates, more companies are increasing their expected earnings than decreasing. You can see that chart on the right that international, small cap, US, emerging markets are all above 1. So when we look at markets, they really tend to price assets on expectations, really not on levels. And the data is telling us that expectations continue to rise based on analysts upgrading earnings estimates. And they're in an upward trend. And historically, this has been a good sign of future highs in equity prices. So corporate America is doing very well. One entity really doing their part to help this recovery in financial assets prices is the Fed. The Fed balance sheet, represented by this bottom chart here, it just continues to grow. And we can argue whether it's right or wrong, whether they need to step back, but it is supportive for assets. M2, which is the amount of money flowing around the system, continues to be elevated. That provides liquidity to financial markets and is good. Fed funds target rate, again, almost at all-time lows at 0.25, so very supportive. In fact, when you look at that balance sheet, it just passed 8 trillion. I think it's a law of large numbers where we get lost sometimes, and sometimes it helps to, have a relative basis to judge that on. And the interesting thing to me is the central bank balance sheet at $8 trillion is now at 8 trillion, larger than every other foreign country's GDP besides China and the US. So if you were going to rank the Fed's balance sheet in terms of GDP, economic output, it's the 3rd largest in the world behind China and the US, which is, to me, I just don't think this is sustainable. And at some point, the balance sheet will have to shrink. I do believe the move will be highly telegraphed by the Fed, so to reduce the shock to the system. We do expect rates to rise, but even with the rate rise, monetary policy is still supportive given these low levels and very supportive of owning risk. It's just a matter of owning the right risk. The other entity that's trying to do its part, but really has less time and less room to maneuver given its financial situation, is the US government. So what we're looking here is a traditional balance sheet for the government. On the left-hand side, right here, you can see the total spending, 6.8 trillion, yes, trillion, just amazing to me. And how we fund that spending on the right-hand side. First glance, without any more stimulus, this isn't accounting for any programs that have not been instituted yet, we need to borrow almost 50% of our annual spending needs. And you really can see that on the left-hand chart. And then we look at how the future unfolds. We look at the right-hand side, don't see an end in sight. As numbers compiled by the nonpartisan CBO, government organization, really point to a further increase in debt as far as the eye can see. You can see that dotted line represents where we are, and anything past that is where they think we're going. In fact, when we look at net debt on the bottom right-hand side, it's never been higher. It's the highest it's ever been since World War II. So this is really a good reason to hold hard assets or precious metals, as something has to give here. And a little protection in your portfolio is not a bad idea right now. The other thing we're looking at arising is inflation. You can look here at CPI in the blue line, CPI core, which takes out energy and food in the red line. We're looking at producer prices on the green line. Without understanding the data, not knowing what's there, you can see it's upward to the right. It's almost, highest it's ever been in a long time. A very tight labor market. We saw the Fed balance sheet. We saw the government stimulus. No wonder we're experiencing decade high inflation rates. The big question, which you probably hear a lot about in the press and what we talk about all the time here at Stonehearth, is this transitory inflation or permanent? The Fed believes, because they have to really, given the record amount of debt we saw that has to be serviced, that it's transitory. I really wouldn't call it Stonehearth views. I wouldn't call it permanent, since nothing is permanent except death and taxes. But I do think inflation will be here for a lot longer than investors and the Fed believe. I do believe it will be persistent. And one way we really look at that is we look at the PPI. So look at the PPI in green, it's up at 6.48%. And we look at CPI, which is what we spend on, at 5 and 4. PPI is the beginning of the production process. So that is measuring prices at the beginning. Think about raw materials, lumber, metals, salaries. Those are really rising at a much higher pace than the end price, what you can charge a consumer. So given that dynamics, it makes sense that prices has to rise. When the end prices have to rise, that increases inflation. So we really don't see an end to inflation anytime soon and before, but it does provide some opportunities, take some inflation hedges for portfolios. So inflation, we don't think it's transitory, we don't think it's permanent, but it will be here for a lot longer than most investors are thinking. Turning to the labor market, the June jobs report saw an addition of some 850,000 jobs created, which is a very positive influence on the economy. Really shows that the expansion is still on track. And I expect a pickup in the rate of growth as we see continued improvement on the COVID front as 2021 unfolds. The negative for the jobs report on the bottom hand chart is, you can see by the green line, that is nominal wages. So that's the actual wages they're increasing by. This purple line, which is in negative territory, is the real wages. That takes out the inflation rate. So even as you're getting more money, what you use that money to spend on is getting more expensive. So you end up feeling a little bit poorer because it doesn't purchase as much as it used to. We can really see that big impact from inflation, that bite is taken out of workers. And this is why we do expect higher rates are in the future, because one way to control inflation is for the Fed to raise rates. Even with good wage growth of 3.7%, you actually feel poorer when you consider the real spending power. This may eventually put a dent in consumer spending, which we saw in the earlier chart, makes up over 70% of GDP. This, I think, will force the Fed's hand, and they'll have to act sooner, and the act will be to raise rates. But until that happens, for now, the overall level of the labor market is conducive to further economic growth. Turning to housing, as you've probably seen or heard or experienced, the housing market is red hot. And we can see that the data is supporting that on the bottom chart, which represents prices. You can see that they're at all-time highs and headed higher. We can also see from the top-hand chart a little slight slowdown in sales, represented by the blue line, and supply, represented by the green line, is really not keeping up with demand. If demand is there, which we think it is, and we can see that by price rising, we see that by actions of consumers, it just makes sense that supply will follow. Houses will be built, which really means an increased economic activity across a broad spectrum as new houses are built and existing ones are modified to meet new expectations. All in all, really another positive influence on the economy, as housing activity has an outsized impact, as it is very labor, material intensive, and leads to further consumer purchases. You just think about your own experience when you bought a house in the past or sold a house. It creates a lot of economic activity, buying new furniture, getting rid of furniture, replacing things, doing renovations to make the house seem how you want it to be. People building houses, doing extensions, all this leads to further economic activity. So all in all, kind of looking at the economic environment right now, it is very positive and conducive to risk assets, and is showing an economy that is fully in expansion mode right now. We've just seen really all those positive influences on the equity market. We'll now, unfortunately, have to take a look at some of the negatives. And the big negative to me is valuation. So what we're looking at here is valuation across multiple asset classes: S&P 500, the US, S&P 400, mid-cap, small-cap, value, see some major countries. On the left-hand side, you're looking at its valuation relative to its history. So how cheap or expensive it is compared to its history. On the right-hand side, we're looking at it as a relative to an investment opportunity. Is it compared to the S&P 500? Is it cheaper or expensive? So green means it's cheap compared to its history or to the S&P 500. Red means it's expensive at that end. Anything in white means it's kind of in the middle. Like we started this presentation, where you take risk matters more than the amount, and there are pockets of opportunity. And you can see that in small cap. It's one of the biggest examples of that. You can see that even though it's trading fairly expensive, it's showing signs of giving some valuation support. And especially when you start comparing it to large cap equities, you can see some really strong valuation support as it's trading almost as cheaply as it has ever been against the S&P 500. So on an absolute basis, nothing looks extremely cheap, as valuations are still on the high end, but there are pockets. When we talk about small cap, a little opportunity in international, which provides a little bit better valuation support. So again, as we're looking to deploy capital for client portfolios, we're really looking at this relative basis, finding where those opportunities are, and where that has some valuation support, which should, in the longer term, provide some excess returns for client portfolios. Another opportunity to take advantage of in the market is to look for classes of stocks that offer good valuation support, at the asset class level, but also between the asset class levels. And we're looking at good valuation support compared to history. And really, as we stated in the beginning of this presentation, we look at the equity markets through a multi-factor lens. And this chart, all it does, groups stocks by their factor characteristics. So stocks that are trading cheap, valuation, may have high yield, smaller cap stocks. Over here, stocks that have exhibited high volatility. Over here, balance sheet, think about quality, strong companies, and margins of high margins. Group stocks by characteristics and compares the current valuation to history, just like the chart we saw in the previous one. And what we're really looking for here is, left-hand side represents the more attractive opportunities in the market. Look at the valuation stocks that are trading cheaply on valuation compared to its history. They're trading even cheaper than they usually are in the market. So that can provide some pockets of opportunity, which is why we like valuation. We like some of the smaller cap stocks. So in general, when we're looking at this, we're looking at the equity market for the longer term investment horizon, we really want to be overweight that left-hand side, and we want to be underweight that right-hand side, which portfolios are positioned for. So another area in the equity markets I like really is clean energy. And I will keep politics and my personal opinion out of this argument and just stick to the data. As no matter what my feeling is or anyone's feeling is on global warming, we really have to invest in the world as it is, not how we want or think it should be. And we look at the data on the left-hand side, it does show the rise in temperatures across the globe. The data is the data. The interesting thing to me for this space is that we look at the right-hand side. We look at the right-hand side. This is in a survey of opinions of U.S. adults on the importance of taking action against on the environment. And we look at it in the brown line, a full 60% of the population says protecting the environment is a top priority. And over 50% say dealing with it is a top priority. Folks, that's a majority. And the trend is only headed higher. This really leads me to believe action will be taken. And it's already happening. And investments in clean energy will be front and center. And we can see that on this next chart. On the left-hand side, we're looking to see this action in play as investments have almost doubled in clean energy in the past decade. As we're seeing costs come down, which is that top right-hand chart, we look at the cost of wind, solar, natural gas, and capacity comes online on the bottom right-hand chart with no signs of slowing. So looking at the data, looking at the opinions of the majority of the population, this clean energy growth thesis is intact and poised to continue. I do believe this offers a good investment opportunity for investors, and it is possible to do good and make money at the same time. So now turning to the yield curve, the fixed income land. And what we talked about, we saw rates come back at the long end. So the yield curve really flattened in the quarter as long rates declined and the short end rose slightly in the quarter. And really what that's telling you, and the read into that is, when we see the yield curve flatten like that, it usually means growth scares are coming into it. We expect slower growth. So investors in general in the second quarter 2021 are expecting a little bit less growth. I think they have the wrong expectations, and it's really driven more by fear. As COVID started making more headlines, they feared an economic shutdown, and they have this really recency bias. And recency bias is behavioral finance, and the fact that our brains tend to put a greater weight on recent events compared to long-term history. So when we start thinking about COVID and we hear the press talking about it, our minds immediately go back to last March and think about all the shutdowns we had. I don't think we're going back there, and the data shows that the vaccinations coming out and the economic activity we're seeing in real time, we just don't see that happening. But that's how investors' minds work sometimes. So when we look at this, we saw the 30-year rate fell over 12% in the quarter, and the 10-year by over 15%. I mean, those are massive moves in the fixed income. That's a normal day in the equity market nowadays, but in fixed income, we just don't see moves like that. So it was a really big move. That short end, like we talked about, and the short end we're looking at is 1 month, 3 months, 6 months here. It really rose as the Fed in their commentary really moved up their timeline for a rate rise. I mean, they moved it up by a month. They're still looking at 2022, but investors took that to mean that it's happening sooner than they thought, and they adjusted the yield curve for that. That was really offset by the Fed commentary that they believe the inflation we are seeing is transitory and not permanent. As we saw in the quarter, investors took the Fed at its word and drove down the long end of the curve in response to this. And like we talked about earlier, we looked at the inflation numbers, we looked at the economy, we looked at the jobs. I just don't see that inflation is transitory. And I think the Fed is really trying to just jawbone investors into doing what it wants, really without having to take any action that may negatively impact the economy, like raising rates sooner than expected, because we saw the exorbitant amount of debt in the economy, and that would put a damper on economic growth. So I am really in the camp of a longer term inflation regime, and I do expect higher inflation to persist longer than expected. As again, we talked about, we have an extremely accommodating Fed, an economy in expansion mode, with the data pointing to increased economic activity. This all leads me to believe inflation is here to stay for a while. Now, that's not necessarily a bad thing. It really must be accounted for when building out portfolios. Allocation to assets that can prosper in a higher inflation environment is a necessity in portfolios. Looking at a longer term chart of interest rates, on the left-hand chart right here, we're looking at the 10-year note. Getting a lot of feedback. All right. Oh, there we go. Again, little technical difficulties here, but all resolved. So looking at this chart, these are 10-year treasury yields, both nominal and real. And when we say real yields, all we mean is we take that nominal and take out inflation. So what you're really feeling when you go to purchase things. And we can see long-term history, it is almost at record lows down here. We saw the big increase in the beginning of the year. And we did see this, it's tough to see from the chart here, but we're seeing the slight pullback, which we saw in the yield curve down to 145. It's actually a little bit lower now. But we see this real 10-year treasury is negative. So what that means is treasuries is a losing proposition. If you hold 10-year treasuries for long term, take into account the current inflation of 3.8%, you actually lose money in purchasing power. So again, not necessarily a bad thing having rates so low, but again, the trend would be that these need to move higher to account for these lack of purchasing power by consumers. And when we look at that, that does provide some opportunities. And we look at the right-hand side, and what we're looking at here is what we call duration. We've mentioned it before. And we don't need to go into the calculation of duration, but what duration really means is for a 1% rise in interest rates, what's the impact of the price on a bond? So the higher the duration, the more negative impact if interest rates were to rise. And you can see that on these bars where the duration lies. You can see that the treasuries have the most duration. So the 30-year treasury, all else being equal, if rates were to rise 1%, you'd lose almost 17% in actual price. So again, what we talked about, where you take risk is much more important than the level of risk, because treasuries are considered a safe instrument. Going out the risk curve, going to some high yield, going to mortgage-backed securities, going to some floating rate, which actually can make money in a rising rate environment, makes sense for client portfolios. So in general, we really want to be overweight credit compared to duration in client portfolios, and we're positioned for a rate rise coming. So that's kind of the overview of the equity, the fixed income, the economic environment. Now we're going to move to our risk model. So we run an internal risk model here at Stonehearth Capital Management. We look at the market and the risk environment through multiple lenses. We look at technical, we look at valuation, we look at economic data, and then we provide a qualitative overlay to that. So when we look at the technical picture, which is made up of two, it's really made up of structure, so how the market's performing, what's performing well, what's not performing well in the market, and reversion. When we look at those two together, we did see a little bit of a weakness, right? It was at a +3, now it's at a +1 compared to last quarter. But still positive technical picture. As you know, a reversion indicator, like we talked about, which really looks for potential trend changes, slipped into negative territory. So giving a warning sign that maybe there's a change of trend in the offering. Nothing confirmed yet, but something to be on the lookout for. But with that, we saw the structure of the market more than offsetting this negative reading in reversion by having a +2. So using the weight of the evidence, taking a step back, looking at the overall technical picture, it still points to a very positive environment for taking risk at a +1. Turning to valuation, which, as no surprise, as we saw earlier in the valuation, is still negative, but we are seeing some improvements. Last quarter, we saw it at a -4. Now it's at a -2, really on the back of those improved earnings as they come in better than expected, and those estimates keep rising. So overall, looking at the valuation picture, still a negative influence for taking risk in client portfolios. Turning to macro, we saw no change, still at its highest level reading that we have in our model, and shows really no signs of slowing, as we need to recover a lot of economic activity to get back to our long-term growth rate. You know, the economic expansion marches on, and this is a very positive influence on the risk environment. Turning to qualitative, again, this takes a look at our experience, the history we have on our investment committee meeting. We have 20 years of investment experience in my camp. Jamie has 20, David has 20, Andrew, a new member of our investment committee meeting, has over 10 years. So there's a lot of experience in there. And this is really looking at other pieces of the market that aren't captured by our model. And really that qualitative reading comes down to really balancing two things. It really is that monetary support we're seeing from the Fed and from the government versus that level of debt. And when we balance those two, it really equates to a neutral reading using that weight of the evidence approach that we use for all our investment analysis. So taking a step back, putting it all together, using that weight of the evidence, using multiple risk lenses, the risk environment really remains positive, really driven by that positive economic data, the still positive technical data, and an improving but not quite positive valuation picture yet. So all in all points to a positive risk environment. So how does this relate to portfolios? So what we're looking here is a portfolio positioning for our moderate risk model as of June 30th, 2021. In the quarter, no changes to our overall position in the quarter. Given the backdrop we've seen, you know, the positive risk environment, we are overweight equities, but where really does matter. We're underweight the US, really driven by that valuation, high valuations, the elevated valuations we're seeing in large cap growth, but we are overweight small cap. We are overweight value stocks. Again, thinking about those previous charts we saw, pieces of the market that have valuation support, that are exposed to an economy that's in expansion mode, and we take advantage of the economy, and cyclically exposed stocks as the economy keeps reopening. So again, neutral weight, internationally developed, and overweight EM really lends that balance to looking for global growth to continue. As we saw in fixed income, you know, we do have record low rates. We do think rates are rising, but we do think there's pockets of opportunity in certain asset classes within fixed income. You know, think about inflation hedges, think about some floating rate bonds, active managed bond funds that can adjust their duration risk, and that all warrants a very neutral viewpoint on fixed income. Same thing with cash. Still say we don't need to hold excess cash in client portfolios for safety. Opportunistic bucket was still neutral. Again, that bucket is really looking more of a shorter term trend, maybe 1 to 3 years, looking for pieces of the market that can really outperform the marketplace. We are finding some, like we do think precious metals works. We hold some silver, we hold some gold. We do have clean energy exposure in that bucket, but given the elevated valuations where we are in the economic cycle, we're not seeing any more opportunities than that right there, and that really equates to a neutral reading. But again, like we said, where you take risk matters, and there are pockets of opportunity, and clean energy and precious metals can provide some excess returns as the market unfolds here in 2021. So that's really where we're positioned in terms of the market, how portfolios are positioned. And now I kind of want to close it out with, you know, just our final thoughts, kind of sum up everything we went through here, because I know we showed a lot of charts, there's a lot of data here, and kind of what does this all mean for people listening on the call today. So again, positive technical market, right? The trend is your friend. Things are looking good from a technical perspective. Valuations elevated, you know, no doubt about it, across financial assets, but we did see pockets of opportunity if you know where to look in terms of those value stocks, some small cap exposure. Looking at clean energy as a good growth story as 2021 and farther beyond unfolds. Really looking at earnings, right? We saw the continued rebound from the lows, which does really help support risk assets. We saw that the economic expansion march is on. Jobs are being created. The housing market is still booming, you know, and on back of that data, we really expect global growth to remain strong through the back half of the year. Massive liquidity being injected into the markets, and this does help support prices. And we all to say around here is don't fight the Fed. If the Fed has your back, go along with the Fed for now. We saw the inflation numbers, right? Definitely elevated. The big discussion Is it transitory? Is it permanent? We do believe inflation is here to stay for a while, and we talked about not really a bad thing, but must be accounted for in portfolios. Looking at rates, right? While the lows may not have been set yet, that trajectory of rates will be higher as we move out 2021 and 2022 unfolds. There's just no doubt about it. It's just a matter of when and the timing. COVID, it's out, all right? We have the Delta variant spread. We have the pace of vaccine acceptance is picking up a little bit, so that has to be balanced. There's really no model that accounts for that, and just something that we have to be cognizant of and monitor on a daily basis to make sure that we're still seeing improvement across the board on the COVID levels. So in closing, positive environment for taking risk. Our traffic light is still in the green zone, but as we've talked about a lot, as 2021 and 2022 unfolds, really where you take risk is more important than the level of risk you take. In terms of where you take risk is going to matter more to portfolio performance and help clients meet their financial goals. So with that, I'll take a quick break, look at the appendix, some compliance disclosures, if there's any lawyers on the call, and I will turn it over to Amanda, who can kind of get to your questions if there are any out there.
Hi, Chris. Thank you so much. Are you able to hear me?
I am, thank you. Yep.
All right, perfect. Yeah, a lot of technology issues today. Happy Friday. We do
I know.
a couple of questions here, and just as a reminder to those who are listening, you can use your GoToMeeting taskbar there to submit your questions, and if we don't get to them today, Chris or myself will reach out to you personally. We'll get your question answered. But just to start off here, Chris, the first one, with the current low rates and your expectations for them to rise, why would someone invest in bonds at all?
Good question. Again, we do expect rates to rise, and normally that has been not the greatest environment for bonds, but we do see pockets of opportunity. And when we think about bonds, what role do they play in the portfolio? They really provide ballast, and the future is never 100% certain. And we're certainly not advocating an overweight position, and really where you take risk matters. So when we saw that duration chart and we saw where the duration impact is greatest, we really want to be underweight those assets and overweight fixed income. But overweight credit compared to duration. It really does play a role because, again, when we've seen before in bear markets and bonds, it's a lot different than equity markets. It does provide some ballast. And when you're saving for retirement or for your financial goals, you really do want to have some ballast in there. So as we saw when we looked at duration on different bond classes, it really is where you take risk. You do need some exposure to help with that volatility and where you take risk. So you want to be underweight duration, think like treasuries, and overweight credit. So bonds can and will provide a role in portfolios going forward.
Chris, what are your thoughts on taxes? Are they going higher? Should someone take any action in their portfolio to kind of prepare for that?
Yeah, it was getting a lot of discussion around here at Stonehearth, I'm sure in everybody's households throughout America. Short answer, yes, they're going higher. I believe they will. And the reason being, we saw the government balance sheet, right? If we keep spending like we do, it will have to be paid for. And someday it has to be paid for, and taxes is how the government funds itself. And it can't fund itself at current levels of spending, never mind any future spending coming down. The trick to me is by how much taxes are going up and on who, right? It really hasn't been decided yet. There's been proposals, but nothing concrete, not even anywhere near concrete, as Washington, as it usually is mired in gridlock. I do think eventually they will come to an agreement. So we are watching this space very closely. But with so many unknowns, it really doesn't make sense to change anything in the portfolio yet. We always here at Stonehearth take a look at taxes for clients and do have an active tax loss selling program in place to help mitigate any tax impact for clients. But you don't want the tail to wag the dog, but we always take into account taxes when building portfolios. So to me, the financial planning process is really where our tax management comes into play. As finding the right balance on the tax front is an integral part of what we do when we create clients' financial plans. And my best advice is if anyone is worried about the tax status or would like to go over some strategies for tax management, I'd really recommend calling our office and really setting up an appointment with one of our advisors who can really walk you through the strategies we employ, including restricted employee stock and stock options, and how a financial plan will really help you manage those tax bite as you go forward.
Yeah, and Chris, it looks like we just have one more question so far here, just to kind of wrap up this webinar. The final question we have is, should I own Bitcoin?
Yeah, would love to own Bitcoin when it was $5,000, not when it's at $30,000 now for Bitcoin. It's interesting. We got a similar question last quarter, and it's coming up more and more in client discussions as it gets out there in the press. When I take a look at Bitcoin and I look at it, I really look at it from two different angles. The first angle I look at it from as, is it a currency, right? I mean, there's a lot of talk about it taking over the dollar, using for transactions, like the dollar. And the second one is as an investment. So I'll take these in two pieces. So I'll take the currency one first because that's the easiest. When we talk about it being maybe a currency replacement for the dollar, I don't think that's going to happen. It really is, the currency is the main way the government manipulates, Freudian slip there, manages the economy. And, they're not really willing to give that up. So if Bitcoin started to move more into the mainstream, I really think they'd put up a fight. And you're really already seeing that. China's coming out with their own digital currency. Turkey banned Bitcoin as a means of payment. The US Fed has a whole task force looking at starting a digital dollar. So again, I don't think Bitcoin, with all that and the ability for the government to manage the currency, will let Bitcoin take over a large piece of in-currency transactions. They're much more likely to create their own currency, digital currency, which we're seeing. Secondly, volatility, right? We've seen Bitcoin move more than 20% in one day. And, in the past year, it's traded anywhere from 20,000 to 60,000 in the past year. Much too volatile to be used in transactions. As part of the definition of a currency, is a stable form of payment. And Bitcoin definitely is not that. And you just think about it. You're going to buy something with Bitcoin, you're going to buy a car, and it's worth 20,000 Bitcoin today. Tomorrow, you turn around and maybe worth 40,000, or even worse for you, it may be worth 10,000. So that volatility just doesn't work when you're looking to spend and set budgets. Lastly, just the speed of Bitcoin. When we look at transactions per Bitcoin, the max amount of transactions they can kind of generate is 4.6 transactions per second, right? So to put that in perspective, you think about Visa, when you use your card at the gas station, you stick it in, you tap it, whatever, they calculate 1,700 transactions per second. People want to spend, don't want to wait around while making a purchase of Bitcoin to go and do its thing on the web. Technology just isn't there yet. Even like Elon Musk, head of Tesla, who was a Bitcoin, convert, loves Bitcoin. He stopped taking Bitcoin as payment for Teslas. So given all that, doesn't really make sense for me that it would take over the dollar or any other foreign currency as a form of payment. The second place is the investment, right? First off, I don't believe it's suitable for a diversified portfolio, just given the volatility we talked about. Some other things to consider if you're thinking about investing in Bitcoin. Bitcoin, while not evil per se, it is a fact that in all recent ransomware attacks, it has been used, right? So it is a tool for criminals. It doesn't mean Bitcoin is necessarily evil, but it facilitates that. So again, that may be a concern when you're looking at the price of Bitcoin. We look at some regulation. Government, when we look at the Colonial Pipeline ransomware, which you probably all heard about, the government was actually able to claw back over 2.3 billion of that payment. Now, and really dense is one of the foundations that Bitcoin is unbreakable, irreversible, can't be hacked. Well, the government just did. So that scares me in terms of an investment standpoint. The government can come in and take it because it's supposed to be able not to be able to do that. Lastly, really tough to value Bitcoin. No cash flows. What is it underlying worth? When is it cheap? When is it expensive? When to buy and sell? It's really tough to get your arms around that. So with all that being said, it can play a role in what we call the aspirational piece of a person's investments. A piece that is, if it went to zero, it wouldn't impact your ability to meet your financial goals, but really looking for that ballistic upside if it materializes. And that really depends on the strength of your own personal balance sheet and financial temperament, which is where having a financial plan comes into play. It will help you understand if you have the capacity from a financial standpoint, or more importantly, the personality for an investment of this type. So working with a financial advisor will help answer these questions for you. If you do decide to buy Bitcoin, trade very carefully, be mindful of these elevated risks, and really work with a financial advisor to understand if it is suitable for your portfolio.
Chris, thank you so much for joining us today, for reviewing all of this with us. I do just want to remind everybody, we do host these free webinars quarterly. Our next one is scheduled for Friday, October 29th at 12 o'clock p.m. Eastern Standard Time. You can go ahead and just sign up for that directly on our website. We hope that you can make it. Again, Chris, thank you so much for joining us, and we hope everyone enjoys the rest of the summer.
Thank you, Amanda, and thank you, everyone.